welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, April 11th, 2022, and I'm pre-recording this Trading Places Live for Tuesday, April 12th. Futures look to extend the losses that we saw on Monday. It is still early. I'm recording this, like I said, in the evening on Monday, so a lot can change overnight. But as of now, I am looking at the Dow futures down 82 points, S&P 500 futures down 15, NASDAQ futures down about 60. So it does look like we will continue the sell-off that we saw on Monday. But Tuesday, we've got CPI report out. And like I said, things can change overnight. So we'll see what happens. Let me go through and go over the agenda with you here before we get started. So I'm going to start off with the daily market recap, as I always do. We'll take a look at Monday's action, then jump into talking technically, take a look at the Spider, Bitcoin, and then also a chart on the core CPI. Accumulation distribution. I'm seeing some signs of accumulation even with the market weakness that we've had in 2022. I think that's a good sign. I'm going to check to see how that stacks up against some earlier periods of volatility in the market. Then earnings spotlight. Here, I'm going to take a look at a few companies that will be reporting later this week. I have one that I think looks really strong heading into earnings. I expect great numbers there. Another one looks just okay. And then two not looking so good. So really the good, the okay, and the ugly. And then we'll wrap up with the three you must see. Three smaller companies. You know, those of you who are more aggressive might like the three I'm going to go over, may not like them. But I do think that they do present some great upside, but with obviously some additional risk as well. All right, before we get into any of that, though, let me take you over to earningsbeats.com. For those of you who are new to Earnings Beats, if you go to earningsbeats.com, scroll down, you will see a free newsletter sign up page there, or a form. All it takes is a name, email address. This is a newsletter that I write 3 times a week, Mondays, Wednesdays, and Fridays. We try to publish it by about 8:30 in the morning, so about an hour before the market opens. And a lot of times, you know, I just focus on some of the things that are important to us. So I'll look at relative strength or earnings, gaps, candlesticks, moving averages, that sort of thing. It's a very quick read, just a couple paragraphs in a chart. Usually start to finish, you'll probably be done with the newsletter within, 5 minutes, 10 minutes tops. So it's very, very quick. And it just provides some nice opportunities for potential trading if you so desire. But go to earningsbeats.com, scroll down, find that area and sign up. There's no credit card required. You can unsubscribe at any time. We'd love to have you. All right, let's move on to the daily market recap. It was not a good day on Wall Street on Monday. Dow Jones Industrial Average down 413 points. The S&P 500 down almost 76. The NASDAQ down 299 points, so one shy of 300. And you can see that that move down now is clearly below the moving averages. This is not a good look on the chart. It certainly appears as though we are probably going to go back down and challenge that the February-March double bottom. I think we could see the same thing on the Dow and the S&P 500. The S&P 500 closed down about 14 points below its 50-day moving average. And the Dow Jones, relative to its 50-day moving average, also closed just beneath it. So not good on the major indices there. Mid caps, small caps didn't do quite as badly on a relative basis, but they were lower. They had already broken below their key moving averages, and they too have the February-March lows in their sights. From a sector perspective, all 11 sectors were down on Monday. So there really was no strength, or at least no positive action. From a relative perspective, energy was the worst performer, down more than 3%. Technology down about 2.5%. Healthcare 1.99%. Discretionary 1.86%. And then real estate 1.37%. So a lot of different areas of the market not performing very well. That was not good action at all on Monday, and likely will lead to further selling on Tuesday. We'll see. 10-year Treasury yield. It did jump again, up another 7 basis points. on Monday, closing at 2.78%. We have seen a huge rise in the last month. Clearly, the bond market expecting to see some more hikes from the Fed. Probably the bond market also, I think we're seeing a sell-off in anticipation of requiring a higher return in order to accommodate the higher inflation rates that we have. So all in all, 10-year Treasury yield continues in this uptrend. As I've been pointing out recently, though, the overall trend on a relative basis in financials has been down throughout much of this move. We did rally on a relative basis here last couple of days, but overall it has been down for the past 6 weeks or so. And I think that's because interest rates are rising for all the wrong reasons, mostly because of inflation, and not so much because of a strengthening economy. If anything, I think we could be looking at the opposite. We could be looking at a contracting economy based on some of the signs that I've been seeing of late. All right. As far as economic reports go, the big one, actually two big ones coming out the next 2 mornings. So Tuesday morning at 8:30, we're going to get the March CPI. Wednesday morning at 8:30, we're going to get the March PPI. So we're going to get inflation at the consumer level first, and then we will get inflation at the producer level second. But they're both supposed to be hot. Even at the core level, March core CPI is expected to rise 0.5%. Same for the March core PPI, 0.5%. The headline numbers for both CPI and PPI expected to rise more than 1%, 1.1%. Both of those numbers were higher than the February level. So we are looking for inflation to pick up steam tomorrow. I expect that we are going to see inflation potentially peak with the reading this month. And that's because the next 3 months, the comparables from a year earlier are all really high. So we're going to lose those high readings and probably replace them with lower readings. So I think the next 3 months, we have an opportunity to see inflation begin to trek a little bit lower. And then that combined with the Fed raising rates and threatening to raise many times, I think that combination could really begin to put a dent in demand. And with more and more discussion about a possible recession, I think all of that combined is going to put downward pressure on inflation as we go throughout the balance of the year. We'll see, but that's what I'm expecting at this point. All right, let's move on to talking technically. First, I wanted to talk about the S&P 500. This is a 3-month hourly chart. And so coming off of the mid-March lows on the spider, you can see we had a really nice rally. This was option expiration week. We had gotten down to the 414 level, and I think we closed, I don't know, this day, I think around 417. And as I explained during our Max Payne session last month, the Tuesday before options expired, we had a lot of potential upside in the near term. There were a ton of in-the-money puts. So the net in-the-money put premium was among the highest I've ever seen in the market. And as a result, it would benefit market makers to see prices go higher because it would cut into the premiums they'd have to pay net of the calls. So it's both puts and calls we look at, but they're on a net basis, there were so many more puts. Anyhow, so we had a huge rally through option expiration, continued to move up a little bit over the next couple of weeks, and then put in the head of what appears to me to be a head and shoulder pattern, topping head and shoulder pattern. Left shoulder, neckline, head, right side of the neckline, right shoulder, and then today, breakdown. This would measure from roughly about 462 down to about 445. That's 17, maybe even 18 points. That would then take us back down to probably around 427, 428, which would be down in here, pretty close to this gap support zone. So you might be looking down there, but ultimately, I wouldn't be surprised to see us go back down and test these lows. Whether it occurs now or maybe we bounce again and kind of go back and forth over the next several weeks, I don't know exactly how it's going to play out. We'll keep watching it. see if we can get some signs to try and call these shifts back and forth. But I don't think that the selling has ended. Based on this chart alone, I would expect that we're going to see some more weakness ahead. Could be tomorrow with that CPI report. And then again, I said Wednesday, the PPI report. We do have options expiring in this week because Friday is Good Friday and the market is closed. Options will be expiring on Thursday. So we only have a couple of days, well, 3 days counting tomorrow. So Tuesday, Wednesday, Thursday before options expire. We are going to have our regular Max Pain event. We always have a webinar the Tuesday before options expire, monthly options expire. And so that is tomorrow. So tomorrow at 4:30, we will have our latest Max Pain event for April. If you are interested in attending, I tell you, we were pounding the table last month on the fact that the market looked like it had to go higher. I mean, you never know for sure, but there was so much money on the table. And anyone who went long that week, this is what you got to see in terms of the S&P 500. From 417 on the close on Tuesday, or maybe it was a little bit higher than that, but we were at 445 by the end of the week. I mean, that was just a crazy, crazy week. But at that point, we began to start this topping pattern. It does look like we have now rolled back over again. All right, Bitcoin. I mean, I was just touting Bitcoin just here over the past couple of weeks when it moved above 45,000. We had all of these tops coming in at about 45,000, could not close above 45,000. Well, we did. And then we went up to about 48,000, came back down. I would have expected this to serve as solid price support along with that rising 20-day EMA. And yet Bitcoin went right through it like a hot knife through butter. So I would not be looking at this as an uptrend at this point. In fact, as we continue to move lower, I'm now looking back to these January, February lows. I wouldn't be surprised to see 35,000 again on Bitcoin based on the way it's trading. So a lot more of this whipsaw, volatile back and forth action. And it appears based on recent action, like 35,000 back in play again. All right, inflation. So this is a chart of inflation at the consumer level. This is the core CPI. And this is the monthly reading or the monthly jump. Well, really the monthly reading down here is the 12-month rate of change. So this is tracking the annual rate of core inflation. But this top part is just tracking the actual consumer price index each month. So StockCharts does track that. You can type in $, CCPI, and that will give you the consumer price index. One thing that you can do if you're not familiar, if you go into Sharp Chart, the symbol area where you can type in a symbol, if you just type in $, it will bring up a lot of different economic reports that StockCharts tracks. So if you're not familiar with that, this is something that you could maybe take a look at if you want to, maybe compare how certain economic reports have come out versus how the S&P 500 is traded. This would be a great way to do it. So here is the CCPI on this chart. And then down below here, I've got the rate of change, 12-month rate of change. And you can see we have been moving very, very high over the past month, or 12 months. We have a new recent high of 6.42%. That is actually the highest level of annual core CPI since back in the early 1980s. So this is kind of a big deal for the market. Now, I think it's still very much related to the pandemic. I don't think that we have an inflation issue. I think we have a short-term problem because of the pandemic. I think this is going to create some great opportunities to buy stocks now and later this year. Maybe the prices keep getting cheaper throughout the summer, but I expect by the time we hit fall, if we haven't already started to move higher, I think we are going to explode back to the upside because I think inflation is going to top. And when inflation tops and we start seeing a definitive move to the downside and the Fed starts talking about putting the brakes on the rate hikes, I think your growth stocks are going to explode. So that's what I'm looking for. Now, as inflation's been going higher, I did put on the bottom of this chart the large cap growth versus large cap value, mid cap growth versus mid cap value, and small cap growth versus small cap value. So I wanted to look at these charts. So as you can see, inflation just continuing to take off. Large cap stocks versus or large cap growth versus large cap value actually was doing pretty well, setting a new high over the 2021 high. Or over even the 2020 high. This was 2020 back here. So 2021, we put in new highs, even though inflation was going up. Inflation's supposed to eat into growth stocks. What's going on? Well, I have a thought about that in just a minute. But let's look at the mid caps. Now, mid caps did not put in a higher high. Mid caps or mid cap growth versus mid cap value put in a lower high in 2021. And small caps were even worse. So small cap growth versus small cap value, the decline was even worse. And look at where we're now sitting. Small cap growth versus value is at a low that we haven't seen in probably about 2 years. Mid cap growth versus value, same thing. We're down just over 2 years. It's been over 2 years since we've seen this level. Large cap versus, or large cap growth versus large cap value is coming down, but it's still above the lows that we saw back roughly a year ago, right here. So why are large cap growth, why is that performing better versus its counterparts on the value side when you compare it to what's going on in the mid caps and small caps, growth versus value? Well, my theory is this. I think when the inflation, when it was just all about inflation and the inflation was going up, I think large cap growth versus value held up better than mid cap and small cap because the companies that make up large cap value are companies like Apple, Microsoft, Tesla. These are companies that, in my opinion, have pricing power. So even though they may have supply chain issues and costs may be going up, I think they were able to pass those costs along. I don't think they were going to have any problems because their customer bases are so loyal. The large cap growth companies, I mean, if you're an Apple fan or if you're a Microsoft fan or a Tesla fan, you're not going to, I don't think you're going to get sticker price shock. I think you're going to continue to remain very loyal to the brands that you like. And so I think as inflation was going up, these stocks were still holding up fairly well because of that brand identity and the brand strength and the pricing power that the companies had. But I think what's changed here over the past, 3, 4, 5 months is I think that Wall Street is rapidly beginning to see a recession on the horizon, or at least the threat of a recession. And no company is immune to a recession, even the large cap companies. If people stop spending money, just because you're a large cap, you got brand identity, doesn't mean people are going to still buy your products. If they're not spending money, they're not buying your products. So I think it's now become a situation where the market's beginning to anticipate a recession, which, listen, it's okay. Recessions happen in the economy from time to time. We're not talking about a depression. We're not talking about an extended recession. We're not talking about 2008, 2009. We're talking about probably something that's going to be very mild. But the market will sell off ahead of it anyway. And it'll start to rebound before you ever even get to the bad news. So I think what's taking place right now is the market is beginning to price in the possibility of a recession. And as Wall Street and all the media begins to acknowledge a recession or the threat of it more and more, prices are already going to be rather deflated, and the market's going to find a bottom in the midst of a lot of bad news. And that's what we're going to be searching for as we go forward. Where is that bottom? I think we're going to go down and probably retest what we saw in February and March, and then we go from there. I don't know where we go from there. Maybe we break down, maybe go to 3,500 on the S&P 500. Maybe we hold the lows, and maybe we turn right back around and go to the upside. But for right now, these inflation reports, the one tomorrow, CPI, the one on Wednesday, PPI, they are going to be all over the news, and they're not going to be pretty. So just get ready for it. Be prepared and understand that as the market drops, it's likely becoming a greater and greater opportunity. Now, it's going to take some patience. I want to stress it's going to take patience to potentially hit a bottom. It could be later this summer before we ultimately begin rallying off of the bottom. So, you'd like to kind of hurry it up, but we're going to have to all exercise some patience to get through this in 2022. All right. So accumulation distribution, let's talk a little bit about this. And what I wanted to do is go back and look at the QQQ during some rather stressful, volatile periods. So I'm going to start with 2000 to 2002. So turn of the century, dot-com bubble. Here was the QQQ. Look at the AD line. We had a little weakness and then bounced back. AD line remained strong. So things still looked pretty good through maybe 2/3 of 2000. But then when we started selling off the latter part of 2000, you can see that AD line went right down with price. So distribution was taking place. It was apparent in the AD line, and obviously it was apparent in the QQQ, which continued to fall precipitously throughout the end of 2000 and throughout 2001 and into 2002. And throughout this period, you can see the AD line, especially throughout 2001, was weak. 2002, it stabilized. And then as we got to the end of 2002, that's when the AD line started to pick back up again. So my point here is that once we really started to see weakness in the QQQ, the AD line went down with it. Distribution. Let's move forward. Next big move down was in 2007 to 2009. Same kind of a setup here. We went down for a little bit, rallied back. We really weren't down that much from, say, November of 2007 until June of 2008, down a little bit, but the AD line was moving higher. It looked like we were continuing to accumulate. Well, in August, when the next big down leg began, check out the AD line. That's when you know it's for real. When you start seeing that kind of movement down with the price action, that's some serious distribution. 2014 through 2016. Here we had that big drop in August of 2015, came back up, and then we had one more move to the downside, January and February of 2016. But the AD line actually was pretty strong throughout. So AD line, if anything, was kind of telling us that any weakness was being accumulated by Wall Street. And that turned out to be a great sign. And 2016, that's when a big rally ensued on the QQQ. 2018 through the first 6 months of 2020. So there is the trade war. Here is the pandemic. Now, the trade war, actually, we saw a low on the AD line go back. It was the last move down that really triggered the selling and the distribution. Prior to that, these other down moves, AD line held up pretty well. So it was just this one period where we went down, hit a bottom, and then rallied back. The pandemic, we actually had movement down in the AD line at the very initial stages of the pandemic. From that point on, even though prices kept going lower, the AD line kept putting in higher lows. So it looked like accumulation was taking place. And that's one of the reasons why we were so bullish back in 2020, was it looked like, it was mostly gap downs at the open. And then some areas would keep going lower, but most of the areas would keep coming back throughout the day. And that was resulting in some strong AD lines. But look what happened. AD line continued to rally. And long before we set a new high on the S&P, we were already setting new highs on the AD line. Really good action there. So with that, now let's fast forward to where we are today. And once again, we're going down, AD line's holding up. We get one little rally, and all of a sudden we break out in the AD line. So this is still painting a not so bearish picture. Even though I think we go lower, I want to continue to watch. Maybe this is the move where we do see the AD line go down with the price. So maybe we get some of that distribution. But right now, it really doesn't look that bad. And so I just wouldn't take too many overly bearish thoughts away from the action based on what we're seeing from the accumulation distribution signal, the AD line. All right, moving on to earnings spotlight. I wanted to go over a few of these earnings that will be out later this week. I'm going to start with one I expect to have a very, very strong report, and that's UnitedHealth Group, UNH. AD line just set a new 52-week high. Price action, same thing. And on a relative basis, UNH is one of the leaders in health among the healthcare providers. So it's got great relative strength, and healthcare providers is broken out versus the S&P. So you got a leading industry group, and UNH is a leading stock within that industry group. Wall Street loves the company. That's all I can tell you based on looking at this chart. So what does that tell me? Well, when the company comes out with earnings, I'm expecting some good news. And you know what? If we get good news and we pull back to key support levels, I would be a buyer. So this is the good report. Now, the next one I'm going to say is okay. This is Fastenal. Fastenal AD line looks good. We haven't broken out yet, but we were in a nice uptrend testing the 20-day. But then you start looking at the relative strength. You know, we had these tops relative to industrial suppliers back here. You know, relative tops. Fastenal was doing really well. Pulled back, went back up, tested that area again, pulled back to a new low, pretty close to a 52-week relative low. And now in the last 6 weeks, we're rallying again. I'm not quite sure what to make of this. So some things tell me it looks okay. Other things tell me it's not really that excited here. So this to me is just kind of okay. And then I'm going to show you two that look really ugly. Morgan Stanley, since topping here in February, it's been a pretty steady move to the downside. Look at the relative weakness now, almost down at a 52-week low. And Goldman Sachs is even worse. Goldman Sachs, it's been moving down since a high in November, and its relative weakness is now at a new 52-week low. The group itself, investment services, hit a 52-week low relative to the S&P within just the last week or so. Bad group, two bad stocks. I would be expecting not great reports when they report later this week. One last chart looking at, you can take two symbols and say, okay, well, Morgan Stanley and Goldman Sachs both look bad. Which one looks worse? Well, this is Morgan Stanley versus Goldman Sachs. And you can see over the course of the last 2 or 3 years, we've got a pretty nice relative uptrend. Morgan Stanley has been the better investment over the last couple of years. So until this trend line breaks, if I had to pick one of the two, I'd go Morgan Stanley. All right, let's wrap this up with the three you must see. First up, and these are some really aggressive stocks. So they are not for everyone. If you find these to be attractive and you want to get in, just understand risks are high on these three stocks I'm going to give you. CTRM, Castor, Maritime. I like this move up and the ascending triangle, equal highs coming across rising lows. And we just broke out above these prior highs. We closed at $1.99. Look at the volume pickup. I think this is one that could make a move to the upside. Next, Gogo. This is one I talked about recently. They added the stock to the S&P Small Cap 600 index. It rallied on the news, sold off almost $5, and then came roaring right back the last couple of days. Very volatile, but still above that 20-day moving average and continuing to perform really well versus its peers. So this is one, if we can get that breakout above the 21, 22 area, this is heavily shorted too, by the way. So it could be looking to move higher. RCUS, this is Arcus Biosciences, just like Gogo, being added, same day, being added to the S&P Small Cap 600. It was almost $40. And now, 4 days later, it's come all the way back down to these recent lows around 31. Could be an interesting turnaround here in the near term on RCUS. But again, very, very volatile. Okay, that's it for me. Appreciate everybody tuning in. Have a great Tuesday, everybody. Watch out for that CPI report, and I'll be back on Wednesday over at earningsbeats.com for your next Trading Places Live. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.